Hello investors, today we're diving deep into Singapore's REIT market and comparing two increasingly popular investment vehicles, Syfe REIT Plus and traditional REIT ETFs. In a financial landscape where property prices continue to rise, REITs offer ordinary investors a chance to own a slice of premium real estate without the hefty capital requirements or deep dive structure and ownership. To direct the ownership advantage with Syfe REIT Plus, you're the beneficial owner of the actual REITs. This creates several interesting implications. Tax efficiency. There's no additional layer of corporate taxation as might occur in some fund structures. Transparency. You can see exactly which REITs you own and in what proportions. Corporate actions. You participate directly in rights issues and other corporate actions. In contrast, ETFs operate as a separate entity that owns the REITs. When you buy an ETF share, you're one step removed from the underlying assets. This creates a cleaner, simpler ownership experience but adds that additional layer between you and the actual REITs. Portfolio construction methodology. Syfe REIT Plus doesn't just passively track the index, it employs an optimized approach. The portfolio managers aim to achieve low tracking error while maintaining sufficient liquidity, sometimes by adjusting weightings of certain REITs. REIT ETFs typically follow strict index tracking methodologies with minimal active management. This creates predictability, but may sometimes result in overexposure to certain sectors or properties based solely on market capitalization. Fees and costs. The hidden impact on returns. Syfe REIT Plus fee structure. Syfe REIT Plus uses a tiered fee structure based on your total investment across all Syfe products. 0.65% annually for investments under $50,000 basic tier. 0.55% annually for $50,000 to $250,000 black tier. 0.45% annually for $250,000 to $1 million gold tier. 0.35% annually for investments above $1 million platinum tier. These are all-in fees, no additional transaction costs, platform fees, or custody charges. This simplicity makes it easier to calculate your true investment costs. REIT ETF cost layers. REIT ETFs have multiple cost components that can be less transparent. Management fee, typically 0.5% to 0.95% annually. Brokerage commissions, usually around 0.08% to 0.28% per transaction. Bid-ask spreads. The CSOPEGS REIT Leaders Index ETF, for example, had an average bid-ask spread of about 0.15% in 2024. Custody and clearing fees, additional small fees charged by brokerages. For buy-and-hold investors, these transaction costs may be minimal, but for regular traders or dollar-cost averagers, they can significantly impact returns over time. The compound impact of fee differences. Let's put this into perspective. A 0.3% difference in annual fees on a $50.00 investment compounds to approximately $3,600 over 20 years, assuming a 6% annual return. This isn't insignificant, especially when considering that REITs are often held as long-term income investments. Dividend treatment. Compounding's hidden tower. Syfe REIT Plus dividend reinvestment. One of Syfe REIT's most compelling features is automatic dividend reinvestment. When your REITs distribute dividends, Syfe automatically reinvests them into your portfolio at no additional cost. This creates a powerful compounding effect. For instance, a portfolio with a 5% dividend yield that reinvests all dividends will grow approximately 28% more over 10 years compared to one that doesn't reinvest, assuming stable prices. ETF dividend distribution. Most Singapore REIT ETFs distribute dividends semi-annually or quarterly directly to your brokerage account or designated bank account. While this provides regular income, it creates what investment professionals call cash drag, idle money not working for you. To reinvest these dividends, you'd need to manually make additional ETF purchases, incurring transaction fees each time. For smaller dividend amounts, these fees might make reinvestment impractical until you've accumulated a larger sum. Liquidity and trading. When timing matters, the ETF liquidity advantage. REIT ETFs offer a significant advantage in liquidity and trading flexibility. Intraday trading. You can buy or sell at any time during market hours. Limit orders. You can set specific price points for execution. Stop-loss orders. You can automate your risk management. Immediate execution. Trades are completed within seconds. This flexibility can be crucial during market volatility or when you need immediate access to capital. Syfe REIT Plus Execution Timeline. Syfe REIT operates on a different timeline. Trade execution. Buy orders typically take 1 to 2 business days to execute. Withdrawal processing. Selling REITs and withdrawing funds usually takes 3 to 4 business days. No intraday timing. You cannot time your entry or exit within the trading day. For long-term investors, this delay may be inconsequential. However, for those who value precise market timing or might need emergency liquidity, this is an important consideration. Risk management. The hybrid approach. Syfe's unique risk management option. Syfe offers an innovative option called REITs with risk management, which incorporates Singapore government bonds alongside REITs. This creates a hybrid portfolio with volatility dampening. Government bonds typically have lower volatility than REITs. Dynamic allocation. The REIT-to-bond ratio adjusts based on market conditions. Downside protection. During market turbulence, the bond component helps stabilize portfolio value. According to Syfe's backtesting, this approach has historically reduced portfolio drawdowns by approximately 20 to 30% during market corrections, while capturing about 80 to 90% of the upside during bull markets. The pure REIT exposure of ETF. Standard REIT ETFs offer pure REIT exposure with no built-in risk management mechanisms. During the 2020 COVID-19 downturn, for example, Singapore REIT ETFs declined by approximately 35 to 40%, while Syfe's risk-managed portfolio limited losses to around 25 to 30%. This difference highlights an important philosophical distinction. REIT ETFs offer pure market exposure, while Syfe's risk-managed option prioritizes risk-adjusted returns. Performance analysis. Beyond where returns historical performance context. From 2020 to early 2025, Singapore REITs experienced significant volatility. COVID-19 impact 2020. Sharp 35 to 40% decline followed by partial recovery. Inflation concerns 2022-2023. Pressure from rising interest rates. Stabilization 2024-2025. Moderate recovery as interest rate expectations moderated. During this period, Syfe REIT Plus reportedly outperformed some comparable REIT ETFs by about 1 to 2% annually after fees. However, this outperformance varied based on which risk management option was selected. The risk-adjusted perspective or returns don't tell the complete story. When analyzing through the lens of risk-adjusted metrics, Sharpe ratio. Syfe's risk-managed portfolio generally achieved a higher Sharpe ratio return per unit of risk. Maximum drawdown. Syfe's risk-managed option experienced smaller maximum drawdowns. Volatility. The standard deviation of returns was typically lower for Syfe's risk-managed portfolio. These metrics suggest that while pure REIT ETFs might occasionally deliver higher raw returns during strong bull markets, Syfe's approach may provide a smoother investment journey. Specialized investment strategies. Sector and geographical tilting. Some investors prefer to overweight specific REIT sectors or geographical areas based on their market outlook. For example, in 2025, many analysts are bullish on industrial REITs due to e-commerce growth and data center REITs due to AI infrastructure demand. REIT ETFs offer varying exposures. CSOP GES REIT Leaders Index ETF. Diversified Singapore exposure. Nikkei Straits Trading Asia ex-Japan REIT ETF. Broader Asian exposure including markets like Hong Kong and Australia. Syfe REIT remains focused primarily on Singapore REITs, limiting geographical diversification opportunities. Dollar cost averaging considerations. For investors practicing dollar cost averaging regular fixed investments, the fee structure becomes particularly important. Syfe REIT Plus allows fee-free regular contributions of any amount, making it highly efficient for small, frequent investments. REIT ETFs can become cost-prohibitive for small regular investments due to minimum brokerage fees, though some brokerages now offer reduced fees for regular savings plans. Tax implications for different investor types. Singapore residents. For Singapore residents, dividends from Singapore REITs are generally tax-exempt at the individual level, regardless of whether received through Syfe REIT Plus or REIT ETFs. International investors. For international investors, the tax situation becomes more complex. Syfe REIT, as the beneficial owner of the REITs, international investors may face withholding taxes based on their country's tax treaties with Singapore. REIT ETFs. The ETF structure might create different tax implications depending on the investor's jurisdiction and applicable tax treaties. Who should choose which option? Ideal Syfe REIT Plus investors, long-term income investors, those focused on dividend reinvestment and compounding. Risk-conscious investors, those who value downside protection over maximum returns. Hands-off investors, those who prefer a more managed approach. Regular small investors, those making frequent small contributions where transaction costs matter. Beginning investors, those who value simplicity and all-in-one solutions. Ideal REIT ETF investors. Active traders, those who value liquidity and precise market timing. Tactical asset allocators, those who adjust exposures based on market conditions. Integration-focused investors, those who want REITs as part of a broader brokerage portfolio. Regional diversification seekers, those looking for specific geographical exposures. Technical traders, those who use technical analysis and specific order types. A hybrid approach, the best of both worlds. Some sophisticated investors adopt a hybrid approach. Core satellite strategy, using Syfe REIT Plus as a core holding for automatic dividend reinvestment, while using REIT ETFs for tactical positions. Risk-tiered approach, allocating long-term funds to Syfe's risk-managed option, while using pure REIT ETFs for higher risk, return potential. Life stage adaptation, starting with Syfe simplicity during wealth accumulation, then transitioning to ETFs during retirement for income control. Future trends to watch. Looking ahead, several trends might influence the comparative advantages of these investment vehicles. Fee compression. Both robo-advisors and ETFs continue to experience downward fee pressure. Platform integration. Increased connectivity between investment platforms. New product development. Both Syfe and ETF providers continue to innovate. Regulatory changes. Singapore's regulatory environment continues to evolve for financial products. Conclusion. Both Syfe REIT Plus and REIT ETFs offer viable paths to Singapore REIT investing, each with distinct advantages aligned with different investor profiles. The choice ultimately depends on your personal investment philosophy, time horizon, and priorities. Syfe REIT Plus offers a more managed, cost-effective approach with automatic dividend reinvestment and risk management, while REIT ETFs provide greater liquidity, trading flexibility, and potentially broader exposures. Remember that regardless of which vehicle you choose, Singapore REITs themselves offer an attractive combination of income and growth potential, making them a valuable component of a diversified investment portfolio. The most important factor isn't necessarily which vehicle you choose, but rather that you start investing in this asset class with a clear strategy aligned with your long-term financial goals. Thanks for watching. If you found this comparison helpful, be sure to like, subscribe, and share your thoughts in the comments below.